So I think it's possible, and that's, I mean, when the, I kind of at the conference, my last slide was highlighting that they've been in a similar situation before, which was the 1940s. And historically, how they and other developed countries got out of this was financial repression. They held interest rates low despite the fact that inflation was happening. And then back then, they also had very strong demographics, and they had this productivity boom, both in the U.S. and like Japan after the war. There were multiple places that had a productivity boom, and they were able to combination of grow out of the debt and inflate out of the debt, even as the nominal debt never really went down and eventually started trending back up again.
Hi everyone, welcome to Smart Invest. Lyn Alden connects the dots between monetary policy, institutional behavior, and network fundamentals to provide a high-level macro analysis of where Bitcoin is likely to go next. According to her, the recent surge in popularity of Bitcoin is a structural reaction to long-standing economic imbalances and the growing need for decentralized hard currency. Alden concentrates on Bitcoin's more fundamental function in the financial system as Ethereum recovers and garners fresh interest due to record-breaking futures, open interest, and user growth. Due to its limited supply, steady issuance schedule, and increasing popularity among both public and private organizations, Bitcoin is in a unique position to profit from fiat devaluation, global debt saturation, and changing investor priorities. She highlights that the current trend is a global shift to digital monetary infrastructure rather than merely a cycle of speculation. A perfect storm for Bitcoin's ascent has been created by the combination of inflationary pressure, tech-driven scarcity, and geopolitical uncertainty. Saylor's bullish thesis is reflected in parts of Alden's analysis, which emphasizes systemic change in addition to price potential through a more comprehensive economic lens. Her conclusion: the world is only now realizing the extent to which Bitcoin is changing from an investment to a necessity.
Yeah, a lot of these things are happening together, which is why it's so persistent. It's a really big Gordian knot, and that's why I keep fading any attempts that they're gonna, claiming that they're gonna get back on track. I mean, earlier this year and kind of late last year after the election, there was this big idea that Doge and Elon Musk are gonna get this back on track, and I was just looking at the math that's saying it's almost impossible. There's very little that they're going to be able to tackle that will actually get this back on track. So one, demographics. Basically, for decades, the baby boomer generation, which is very big, was paying into the system, and now that they're effectively retired and increasingly retired as the years go on, as even the youngest baby boomers start to retire, they're now in big drawdown mode. And so over the next 10 years, the existing 3 trillion in the Social Security Trust, which is held by intra-government debt, it's kind of the wonky accounting that they do, but that's going to basically pour back into the economy and transfer to external debt. And that's spendable income that enters the broader circulating economy. Then there's the interest expense. So for, like you said, for 40 years, we had rising debt to GDP but falling interest rates. And right around the same time the demographics started to roll over, we hit zero interest rates, bounced off zero. And now we have rising debt to GDP, but no longer declining interest rates. So you don't even have to assume that interest rates are going to go up. If they just kind of chop around sideways for the foreseeable future, interest expense starts becoming a very meaningful percent. It just passed defense. It's now like the biggest component after Social Security. And if it keeps going, it'll eventually pass even Social Security. Defense spending as a percentage of GDP was falling for a while as we kind of exited the Cold War. But a lot of things, the kind of theme is things don't have to ramp up rapidly. Just if you have a mild trend change, that can really matter. So if you go from shrinking military spending as a percentage of GDP just like flat or mildly up, that's a trend change. That really makes a difference in some of these marginal numbers. U.S. has the highest healthcare costs in the world on a per capita basis, and so that's a whole topic in and of itself that's very hard to unravel. So people often point to Japan, but Japan, despite being on average 10 years older, has much lower healthcare costs per capita. They live longer. A lot of factors there. But the United States has, the other part of retirement spending besides Social Security is the whole Medicare spending and the broader healthcare industry. And so basically for 10 plus years, basically any sort of investment horizon that anyone can plan around, the deficits are virtually unassailable. And then kind of the punchline, which I didn't get to at the conference, but I've written to before because it's a somewhat of a longer topic, is that compared to many other developed countries, like let's say Germany or Canada or whatever, the United States' tax receipts are more closely tied to its stock market performance. Um, that's partially due to the fact that we're a global kind of hub for equity capital, that the whole world wants to invest in our equities. It's partially because we have higher wealth concentration than many other developed countries, and it's partially because of our nuances of our tax code. And so basically, when you if they even if they actually do a pretty good attempt at austerity, when you kind of fast forward 12 months or so, it'll be like a recursive thing where now their tax receipts are suffering because of the way they structured things. And so nothing short of a kind of complete overhaul would even get close to tackling this. And there's nothing on the cards for that politically. So I think it's possible. And that's, I mean, when the I kind of at the conference, my last slide was highlighting that they've been in a similar situation before, which was the 1940s. And historically, how they and other developed countries got out of this was financial repression. They held interest rates low despite the fact that inflation was happening. And then back then, they also had very strong demographics, and they had this productivity boom, both in the U.S. and like Japan after the war. There were multiple places that had a productivity boom, and they were able to combination of grow out of the debt and inflate out of the debt, even as the nominal debt never really went down and eventually started trending back up again.
On June 10th, Ethereum broke out of a lengthy trading range to reach a 15-week high of about $2,827, indicating new signs of strength. This rally has rekindled expectations that a clear move above the $3,000 barrier is imminent, following weeks of consolidation between $2,300 and $2,800. Strategic whale activity is supporting the momentum. One significant holder recently made about $31 million in profits over 44 days, including a huge 30,000 ETH sale that coincided almost exactly with the price spike. Ethereum's network fundamentals are displaying bullish signals in addition to price action. Growth on the base layer 2 network was a major factor in the 70% increase in unique wallet addresses in Q2, which reached a record 17.4 million. Meanwhile, Ethereum's mainnet continues to see high user engagement. Ethereum continues to dominate the DeFi market, controlling 61% of the total value locked in the sector, or roughly $66 billion. Concerns regarding staker yields and long-term validator incentives have been raised, though, as network fees have decreased to just about $43.3 million in the last month. Ethereum futures are currently the biggest wildcard, with open interest reaching an all-time high of about $40 billion. Nearly $1.8 billion in short positions could be liquidated if ETH crosses $2,900, potentially igniting a breakout rally. The market is still very volatile, though, and traders are keeping a close eye out for the next big move.
Yeah, that's part of the inflating away component. They basically that's the bag holder component, and some of that was tricking people into be it, and some of it is like force. Like in America, they banned gold ownership, which is crazy. For like 40 years, Americans could not own gold, and there were other things that just kind of stuffed capital in place. There's also banks. An unusually high percentage of their assets were treasuries because they were kind of forced into like these public utilities. They were basically there for holding treasuries for a period of time. That was kind of that was like another offset. And so as we look forward, let's say they do cut interest rates, which is certainly possible. If we have, for example, you know, pretty rapid gains in say AI, keeping white collar wages not growing very quickly, and kind of at a productivity boom from there, and kind of the way that they choose to measure CPI is not particularly going up very quickly, which gives them levers to kind of cut interest rates. That's certainly possible, but then it just goes back to, you know, you still have the other component, you still have the Social Security component, you still have the Medicare component, you still have the defense component, you still have that whole complex. Interest rates are one of the key factors, but then it goes back to also the prior point of it's a trend change. So even if interest rates don't keep going up, or even if they don't stay at the level they are now, and the important thing is they're not falling anymore. Even if interest rates go back down to say 2% on the short end and 4% on the long end or whatever the case may be, that's still not an offset. It used to be an offset to the rising debt levels, and now it's just kind of in the static range potentially. And then in addition, if you do get a much lower interest rate, right now there's this kind of like there's still a hawkishness behind the dollar. So there's a lot of developing countries out there that have dollar-denominated debt. It's something like $18 trillion in dollar-denominated debt. I think of which 13 is like held by non-banks and the rest is held by banks. Um, that's in developed countries, that's in emerging markets, it's kind of all blended. That's part of the euro dollar system. And all of that represents inflexible demand for dollars. So when the dollar gets kind of strong, it squeezes them. If we do get a much lower interest rate on the dollar, that allows a lot of those other countries to ease their monetary policies as well because they're not kind of struggling against that strong dollar as much. You potentially get kind of a BRICS boom or like an emerging market boom cycle. You potentially get higher energy prices from that. Right now, because of the more sluggish global economy, it's one of the factors keeping oil prices pretty much in line. And so that's another factor that can kind of happen. And then at the conference, I highlighted that gold and other scarce assets tend to have this inverse relationship to real rates historically, which is, if U.S. money supply is growing at 7 or 8% per year, most people aren't looking at that. They're looking at CPI, but still, it's growing at a pace. If they feel like they're getting paid 4 or 5%, they're more willing to hold on to that, especially in this kind of regulated environment they operate in. But if they're getting paid 0, 1 or 2%, and that money supply is still growing, they're more likely to get into gold or in our case, Bitcoin. And so even if we get this kind of low interest rate environment and deficits slow down a little bit, that's still really good for the assets that I'm talking about. And so that's kind of the wonderland snare we're in now. Whereas higher interest rates have one mechanism of accelerating this, and lower interest rates have another mechanism of accelerating this, because it's kind of less of a free lunch now than there was during the structurally declining interest rate environment. Yeah, I agree. And in developed countries where the liabilities are in their own currency, it's almost always the devaluation option, which and I consider that a default as well. Basically, if you massively devalue bondholders on a purchasing power basis, then that's a type of default. And basically, when you kind of we've gone through this cycle, we keep building up private sector debt. Then it gets so bad that they transfer a lot of it to the public sector. They kind of have this kind of rotation that happens. And when it's all in the public sector, there's really nowhere else for it to go other than default. And if you're an emerging market, you often default nominally because you literally just can't acquire the dollars that you pay back, much like a private corporation. Whereas if you're the United States government, you print the difference. And depending on the level of productivity, that will affect how much bondholders even realize that. Because, for example, during the 1950s, 60s period, bondholders weren't exactly complaining, and yet they were underperforming basically anything else. So stock market was going up. Most other asset prices were going up. Bondholders and currency holders were the bag holders. Whereas in the 70s or in the past 5 years, when you have more productivity challenges, the bondholders feel it more. And so it's not basically if there's bad productivity, the bondholders can underperform even basic goods like energy prices, for example. If there's really good productivity, they'll still massively underperform like high quality financial assets that have scarcity to them. Things like gold, Bitcoin, art, best high quality real estate. It still kind of underperforms the things that we're not getting more productive in making. Because there's that big spectrum in terms of things that are actually scarce versus things like electronics or textiles or whatever the case may be that we're getting radically more productive in making over time.
Michael Saylor's unwavering belief that Bitcoin will reach approximately $1 million per coin is causing a stir in the cryptocurrency world once more. He calmly dismissed concerns of a crypto winter in a recent interview with Bloomberg, saying, "Winter is not coming back. We're past that phase. Bitcoin will reach about $1 million if it doesn't drop to zero." The fixed supply model of Bitcoin and the quickly increasing institutional demand serve as the foundation for his audacious prediction. Since there are only 450 new Bitcoins mined and sold every day, which is worth about $50 million, Saylor contends that even a small amount of daily buying pressure is sufficient to raise the price because of Bitcoin's strict scarcity. His company, MicroStrategy, has actively supported this theory and is now among the biggest institutional Bitcoin holders in the world, holding an astounding 582,000 Bitcoin valued at over $63 billion. Saylor also cited changing institutional and political sentiment as important motivators, citing the fact that financial behemoths like BlackRock have fully entered the digital asset market and that Donald Trump now openly supports Bitcoin. As a sign that Bitcoin is becoming an essential component of the global monetary infrastructure rather than a fringe asset, even nation-states like Pakistan are starting to accumulate strategic Bitcoin reserves. Saylor is unambiguous. Bitcoin's long-term trajectory is one of exponential growth, and those who don't position themselves early risk falling behind, even though he concedes that there may be significant corrections along the way.